Good morning and welcome to the CT Global Managed Portfolio Trust Investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and could be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Paul Green, Portfolio Manager. Good morning, sir.
Good morning, ladies and gentlemen. Welcome to the presentation on CT Global Managed Portfolio Trust. My name is Paul Green and I'm joined by my co-manager on the trust, Adam Norris. I'll spend some time recapping on the trust and our process, and then I'll pass over to Adam, who will walk through on some of the changes that we've been making since the end of May when we last spoke to you, and we will share some portfolio examples and then provide an outlook. So just as a reminder, CT Global Managed Portfolio Trust has three unique features. Firstly, it has two separate portfolios: the growth portfolio, which has a capital growth objective, and the income portfolio, which looks to provide an attractive level of income with the potential for capital growth. The current yield on the income portfolio, for example, is around 6%. The second feature is that any income generated within the growth portfolio is transferred and exchanged for capital with the income portfolio. The result there is there's a boosting of dividends for the income shareholders in exchange for capital for growth shareholders. And then thirdly is the annual conversion facility, where each October investors can elect to transfer their shares from one portfolio to the other. So for example, if you've been invested in the growth portfolio, generated some capital returns, and then you reach a stage in your life where you think boosting your income might be an option, you can then once a year elect to transfer your shares over to the income portfolio. And with current CGT rules, that is exempt of CGT, so it's quite an attractive option. And then finally, just to mention on discounts, obviously it's a very attractive time to be investing in investment companies. There's quite a lot of discounts available, but as a trust of investment trusts, what we try and do is keep a tight control of the discounts on our trust to avoid that double discount phenomena. Okay, last time we presented, we spent some time running through the process in a bit more detail. So I won't go through it in as much detail this time, but really just to recap. So in terms of looking through the building blocks, we'll look at some aspects of investment trust selection, meeting managers and our scorecard, and then using analytics. So starting off really just with the building blocks. So this is sort of the North Star for the way we think about investing. And this is when we work with our multi-asset team colleagues, we assess the most attractive areas of the market to deploy capital over a medium-term view. And this is known as strategic asset allocation. We analyse aspects such as economies, politics, valuation, investor positioning, and then we come up with a view of where we think it's best to deploy capital over the medium term. Obviously, there can be periods where shorter term volatility, like what's happening on at the moment in terms of software, we can come on to that in a bit more detail later, but you get some opportunities to take advantage of shorter term trades. So we also implement some tactical asset allocation. But it's really trust selection where Adam and I spend much of our time. This is a bit of a picture of our scorecard that we've developed. We meet with trust managers on a regular basis, whether it's managers that we're already invested with or any potential new ideas. In fact, over the last 7 months, between us, we've had over 125 meetings or calls with managers on investors' behalf. And once we've had that meeting with the manager, we really like to make sure we completely understand the process and what it could potentially deliver for the portfolios. So we write a detailed process note, making sure that we've covered all the aspects and make sure we fully understand them. And then we turn to our investment trust scorecard. I think Adam talked through this in a bit more detail last time, but I'll just recap. Really, this is to make sure that we've analysed every aspect of what we believe it takes to be considered for investment in our portfolios. And we score areas such as our knowledge on the asset class, the investment manager's process, the skill and resource, and then we look at corporate governance, which is looking at the board experience and previous capital allocation policies. And then we turn to the structure. So is the trust making use of the extended flexibility of the trust structure in terms of gearing or position sizing, etc. And then the final aspect to touch on is analytics. And it forms an important part of how we think about portfolio construction, and we'll come on to some of the changes that we've made to the portfolio so far. But essentially, we want to build portfolios that are both diversified and have conviction. And this means removing trusts that own the same or very similar stocks and instead focus on our best ideas. In other words, we're trying to remove the illusion of diversification. You can hold 50 trusts in a portfolio, but if they're all doing the same thing, you're not getting any diversification of outcome. We don't want the portfolios to have a permanent style bias either, and using systems like style analytics, which you can see on the top half of this slide, it really shows you, where the manager is taking their risk. Are they a value manager? Are they a growth manager? And then you can blend them together to make sure you haven't got a dominant style through time. So with that, I'll pass over to Adam, who will talk through some of the changes that we've made to our portfolios over the last 6 months or so.
Thank you, Paul. Good morning, all. It has been a very busy period. Paul alluded to the number of meetings we had. So it's been a busy period in terms of meeting with managers, but also in terms of portfolio turnover too. And we've tried to capture this in sort of some favoured areas of ours, which we've called investment themes here. And we'll come back to actually how that has manifested in positioning in the next slide. But just to kick off, Asia and emerging markets. Now, emerging markets have had a bit of a lost decade. If you think about, it's important to differentiate between emerging market economies, which continue to converge on developed economies. So that is emerging markets catching up. But in terms of markets, earnings growth, as measured in earnings per share within emerging markets, well, they've had pretty much 10 years of no growth. So when measured in dollar terms, emerging market earnings per share is the same as it was in 2015. Yet, in our view, sort of paradoxically to that, outside of US equities, we see, particularly within, say, Chinese technology companies, some of the most innovative businesses globally. So take Chinese tech, spending ferocious amounts of cash to develop their artificial intelligence capacity. Yet at the same time, these really profitable companies are showing signs of shareholder friendliness. So big, large share buybacks and dividend policies, as well as investing huge amounts into future growth. So at the beginning of this financial year, which started in June early this year, when we took on the managed portfolio trust, we've begun significantly adding to this area. And Paul touched on earlier in terms of the work we do as an overall CT multi-asset team. Well, one of the areas we tend to focus on is where is investor positioning and flows. And if with emerging markets this year, or coming into this year, the largest flows into emerging markets for 4 years. And if we contrast that with the UK, we still see significant headwinds of flows. So that's investors taking their money out of the UK and potentially into Asia and emerging markets. We've got an example for each of these sectors here. The one we use today is Invesco Asia Dragon, which I'll come back to shortly. The second point, the middle one, infrastructure. Now, I'm sure lots of listeners and watchers today use artificial intelligence in terms of chat tools, etc. And we hear lots about it in the media. But and over the last 10 years, technology businesses have really powered market returns. But there is a real difference, we think, with this mini cycle, in that the next leg of this technology growth, and we are believers in technology growth, is driven by hardware investment. So this is capex in supply chains. This is capex into data centers. This is capex into overall infrastructure. And so it's not about necessarily who are the winners and losers in terms of the end product, but who are really providing the picks and shovels to the masses. And we can see it, vast amounts of cash being deployed by companies to fund this future growth. And so we'll come back to an example how we're using an investment trust, Pantheon Infrastructure, to capture some of this infrastructure spend for us. And then finally, private equity. We're really excited by what we see in private equity at the moment. It's been a tough period over the last 2 to 3 years now in a poor exit environment. And what do we mean by exit environment? It's the ability for private equity managers to sell on their companies. It could be an IPO into the public markets. It could be selling on to another private equity manager. It's been a very tough period. And historically, when we've looked at private equity trusts, the performance can be most strong coming out when exit markets are good, and managers recognize an uplift when they sell their assets on. And so it's been a bit of a fallow period. We see the IPO market beginning to thaw in public markets, which should start that private equity wheel once again. And so we've added to that area. And then just one final point on private equity. When it comes to private equity, we've long thought that private equity has eaten the lunch of small cap investing. And small cap investing, private equity companies have stayed private for longer and perhaps haven't come to the public markets. And so investors haven't really captured that growth within small cap. It's been in that private sphere instead. But these private companies are staying private for longer and getting larger and larger and larger. And we've come back to an example of this with the Schiehallion fund, which is a Baillie Gifford managed investment trust in a short while. So we run two portfolios within the Global Managed Portfolio Trust, starting with the growth portfolio and highlighting some of our additions and reductions here, the bold being the additions that we've made and the unbold are the reductions. And you can see our largest single exposure is to listed private equity, which have increased 2.6% so far this year. I've touched on our favourable view of listed private equity, and some of our larger holdings include Oakley Capital Investments, which we've added to, and the Schiehallion fund, which I'll come back to in a short while. Perhaps just touching on the largest switch in allocations, though, has been towards Asia and emerging markets. We've moved roughly 10% of the portfolio towards investment trusts, which are investing in this area. And we've moved away from the UK to do that. And just a quick note on the UK, we see UK is cheap, optically cheap, but when you adjust for that sector composition, less so. Looks pretty much in line with many parts of the world outside of the US. And so within the UK, we've moved towards more what we think are growth opportunities in mid and small cap, and Paul will come back to some of the changes we've made later in this presentation. Back on the major emerging markets, new holdings include Invesco Asia Dragon, and Fidelity Emerging Markets within the growth portfolio. Fidelity Emerging Markets was one of the best performing investment trusts of 2025. It was up over 50%, and it's added another 10% already the year to date. Within global technology, most of this is accounted for from Polar Capital Technology Trust, which is now one of our largest single exposures in the growth portfolio. And it's quite interesting, it's very relevant actually, that they continue to pivot their portfolio towards this AI infrastructure supply chain and away from software, where the business models, in their view, is somewhat under threat, even though they've owned some of those software businesses for, say, 10 years prior to this. Within North America, we've added to that region or sector, predominantly through Bill Ackman's Pershing Square. In 2025, performance was strong, and not that much related to AI in our view. They own Google or Alphabet, but really there's an interesting deal going on there where they've used one of their companies to acquire an insurance company through one of its portfolio holdings, and they're going to use that insurance to invest in smaller businesses with high growth potential. So potentially interesting new leg of growth there. And then one to pick out is alternatives, which show a net reduction of 2.6%, but this is a catch-all bucket. Our reductions within alternatives have tended to be in more defensive investment trusts or multi-asset trusts. So we've fully sold personal assets trust from the portfolio, and we've reduced BH macro. So this reduction masks our overall favourable view of some of the alternative areas, and we've used some of these proceeds to add to public and private equity. And you're going to have to excuse us. We've got growth portfolios up the top, allocations up the top. It should say income portfolio allocations, nothing like a bit of live TV. But it just in terms of the income portfolio, very similar to the growth portfolio. Substantial move away from UK focused investment trusts. It's still highly represented. There's still good yield opportunities within the UK, and it's represented by 27% allocation for now. But we really do intend to use the more global remit of the CT Global Managed Portfolio Trust. So starting with the optical contrast to the growth portfolio, which is adding to alternatives here. New names for us include GCP Infrastructure, Pantheon Infrastructure, and Cordiant Digital Infrastructure. I'm sure you get the theme there. The second two, Pantheon and Cordiant, we see really strong NAV growth, and investors are still able to access this at a discount to that net asset value. And yet we still see strong growth to come. So Cordiant is working on a data center build out in one of its large portfolio companies. And Pantheon, I'll come back to as a bit of a case study as to why we like that too. We've increased some of the bonds and direct lending trusts. We see high yields available within bond markets still, and so good for income. And a new holding here is 24 Income Fund. And then not forgetting the allocations, much similar to the growth portfolio, which is adding to Asian emerging market trusts, topping up existing holdings, as well as introducing Invesco Asia Dragon to the mix as well. So I've talked about Invesco Asia Dragon. Here it is, the case study. We've called this in our interim report, Emerging After a Decade to Forget. Now, Invesco Asia Dragon, we capture Asia and emerging markets as one, given the very high overlap between the regions. We think it's a very interesting trust. The Invesco Asia team managed almost 30 billion AUM, 5.9 billion in this single strategy. It's managed by Fiona Yang and Ian Hargreaves. And what we like about the investment trust is Asia and emerging markets has been a difficult place to invest. It's been quite choppy. And as I said, no growth in earnings per share for over 10 years until very recently. But the team are not wedded to a particular investment style. So they're not unashamed growth investors. They're not, die in the wall value investors. They really try and standardize the different stocks that they look at to try and capture what they see are compelling total returns. And Paul touched on what we like about investment trusts in terms of when we're analysing on our scorecard, the use of the structure. Now, this is not just a portfolio manager exercise, this is looking at the board too. But the investment trust pays an aggregate 4% dividend yield struck on NAV. And what does that do? That means that investors can own this trust for both income and capital, but the portfolio managers, Fiona and Ian, aren't targeting yield for yield's sake within the portfolio. And particularly when you look at Asia and emerging markets, we see lots of value traps. And value traps, in our view, are businesses which have high yields. Maybe that's great, or maybe they just don't grow. And maybe that capital comes down over time and the yield gets higher. And we don't think that's necessarily a great way of investing. There's some merit, perhaps some merit in terms of re-rating them in time. But overall, we want to focus on total return. And the investment trust structure allows the managers to focus on total return. Another difference between other portfolios which they manage or which investors can access is that is this concentrated portfolio. So the top 10 holdings are roughly 50% of the portfolio, nice and concentrated for us. Really, it gives us bang for our buck when we're allocating to the trust. But also, if we compare it to, say, an open-ended equivalent, which investors can invest in on platforms, etc., well, they tend to have roughly a 10% limit, 10% holding limit on what they can own. Within the investment trust structure, not so much. Their largest position is TSMC, the Taiwanese producer of semiconductor chips, which is 11% of the exposure, so good use of the structure there too. And because they're focused on total return, and it's the investment trust structure which allows this higher yield, we think it's a great candidate for both the growth and income portfolio. So we have around 3% of exposure with an income portfolio, and actually 5% of the growth portfolio is invested in Invesco Asia Dragon now. Infrastructure in a hardware revolution. Sorry for the punchy title, but we really believe that this is a hardware cycle. Pantheon Infrastructure, PINT's not just the best ticker in the market, but a very exciting investment trust too. It is managed by Pantheon, and it provides us infrastructure opportunities that are only found in the private world. And we've said AI infrastructure has taken enormous amounts of capital. PINT have companies all the way through this supply chain. So they've got data center businesses, which are really at the cutting edge of AI infrastructure, but also power generating businesses, because it takes a huge amount of power for these companies to operate. And they've managed to see in this kind of sort of low exit environment, 2 of their companies have already been sold on. Now, just touching on Pantheon very quickly, they are co-investors. And what does that mean? That means that they're sort of junior investors. They invest with other managers. And so it's the other managers which decide when to buy or sell the company. But they underwrite the deal and they see them as strong growth prospects. So the first exit has come from Calpine Energy, which is now on the process of being exited to a larger listed equivalent. They made a handsome return over a 3-year holding period there. But really interesting, in September, they announced a new investment into Intersect Power. And it's managed by another private equity manager, as I said. And within 3 months, the Intersect Power has been sold on already, sold on to Google or Alphabet, who are trying to control their own data center supply chain. And we think they've made over 1/3 profit in just 3 months on that holding. So it just shows they're really able to access these crucial points in supply chains, very attractive companies, and deliver returns for shareholders as a result. And then my last example is pent-up private equity value. What do we mean by pent-up private equity value? Really, that the private equities had a tough period of exits, which I've covered. And we've covered Oakley Capital in a previous presentation, but one area we added to, which has performed very well over the last few months, is the Schiehallion fund. It's a Baillie Gifford managed private equity trust. And it's a mixture, in our view, of growth private managers, growth private companies, and a bit of venture. Now, Baillie Gifford will say that it's more growth focused, but just how does venture capital tend to work? You have a few big winners in the portfolio and quite a few losers, but those big winners really dominate returns and compound very strongly. And after a tough period of performance through 2022 to 2024, we're starting to see the fruits of that approach coming forward, with some of the bigger companies now really coming to the surface of the portfolio. Probably the most famous of which is SpaceX. SpaceX, the Elon Musk private managed or run private company, not just launching rockets, but actually over nearly 10,000 satellites into space. And the launching 10,000 satellites into space, and they're providing network coverage to areas of the world which have been uncovered or low network quality. So think shipping, think offshore rigs, think airlines, and even battlefields, and they are the market leader. And I touched earlier about how these private businesses are growing and growing and growing. Well, Schiehallion, and this is on December numbers. We were putting this presentation together last week with an $800 billion value. Now, in comparison, that is larger than the top 3 holdings of the FTSE 100 combined. So if this was listed, it would be by far, listed in the UK, which it obviously won't be, but by far and away the largest FTSE 100 component. And this is in the private world. And we think we're able to access and capture the growth through some London listed investment trusts. And the NAV of Schiehallion has pushed higher ever since, and or since last year, really, on the uplifts achieved through SpaceX. And there's tout that SpaceX will be brought to market later this year. We shall see on that. But actually, the value of SpaceX is now reported to be 1 trillion, and that is before you adding the deal that they've done with another Elon Musk portfolio company early this week. But we'll park that for now. But it's not just this one asset that we're focused on, although it is we think a very special asset within the Schiehallion fund. But other portfolio companies, Bending Spoons, not necessarily a household name. The valuation's up over 300% in just 2 years. They basically buy other technology business, clean them up, make them more profitable, almost like a mini private equity company within the private sphere, and has generated handsome returns too. Databricks, which is plugged into the AI supply chain, his valuation was up 100% in 2025. And so this is now 3% of our growth portfolio, and has been a very strong performer in recent months.
Okay, I'll let Adam have a bit of a breather there. Thank you very much. And yes, Adam mentioned that I was going to talk through what's been going on in the UK. So we have seen an overall reduction. And in terms of where we see the value, yeah, the UK market does look cheap. Adam has mentioned on a sector adjusted basis, less so, but where the cheapness is really is in the mid and small cap area of the market, the domestic names. We've seen some good returns actually from large cap, particularly large cap value strategies over the last 12, 18 months. But it's very hard to see a catalyst in the near term for what will make the broad mid and small cap market re-rate. So what we've done instead is we've found some investments that really rely on self-help rather than a re-rating of the entire market. So over the past months, we've added both the Odessian Investment Trust, you can see that as the middle column there, managed by Stuart Widdowson, and Strategic Equity Capital on the right-hand side, and that is managed by Ken Watton. And these trusts might look very similar from the outside. They invest in a very similar area of the market, which is small cap UK equity. They both adopt a corporate engagement style of investing, so self-help, really getting a large stake in businesses to try and help them unlock value, whether that is changing boards or changing management teams or changing business direction. They're taking big stakes to help them achieve that. So you would think there'd be quite a bit of overlap between these portfolios, but in fact there's only one name that they share between them. So we've said in the past that what we're trying to do when we bring portfolios into, bring trusts into the portfolio is that we want to avoid having trusts in there that have a large overlap of names. So across these two portfolios, they just hold Spire Healthcare. And what we like about them in particular, apart from going through the corporate engagement angle, which can be very beneficial in a cheap market like the UK, that can attract some, still some very active M&A activity that we've seen over the last 12 months or so. We think that a self-help engagement proposition is likely to assist in that regard. And they also make full use of the flexibility of the trust. So if you look at the top 10 of the Odessian Investment Trust, that accounts for 88% of their portfolio. So very highly concentrated, very high conviction. And similarly, Strategic Equity Capital, their top 10 is 73%. No large cap, a little bit of mid cap, but mainly investing in the small cap space. So we've talked about quite a few of the positions that we've been adding to over the last 7 months or so, but of course to finance that we have to sell positions. So on the left-hand column you see the trusts that we've sold from a growth portfolio, and then on the right-hand side you see the trusts that we've sold from the income portfolio. The reasons for these sales range from reducing similar investments as we've spoken about. It could be rebalancing the overall style mix of the portfolio. Did we have too much growth? Did we have too much value? Just redressing that. Or it could be asset allocation driven. So as Adam mentioned at the start, we've been reducing UK. We see more value in Asia and emerging markets with earnings per share growing potentially. So we've made that shift. So it doesn't necessarily reflect badly on these trusts that you see on these columns. For example, we sold Lord Debenture and Lowland from the growth portfolio, but they remain very much part of the income portfolio. We think they're more appropriate for the income portfolio than they are the growth. So just turning to the top 10 growth portfolio, the names in bold are new additions. So JP Morgan, Global Growth and Income, Invesco Asia Dragon, Adam's already spoken about, and Fidelity Emerging Markets. They were all new additions over the last 7 months. When we spoke to you, I think the last webinar we did was in July. We were talking much more about our vision for the future. We said that the top 10 of the portfolios will likely represent a larger proportion of the trust, and that has been the direction of travel. So the top 10 of the growth portfolio is currently 47%, and that's moved up from 37 in May. Number of holdings have gone down to 36 from 39, and that is something that we said we would do. We were going to reduce the number of holdings and move into sort of higher conviction positions. And we expect to be, by the end of the financial year in May, we expect to be around about 30 names in the portfolio. Oh, I've gone too far, I think, there. Okay, there's the income. At least it's got the income name on top of it this time. This is the income top 10, and you can see a very similar trend here. The top 10 now accounts for 42% of the portfolio, up from 37. Holdings down to 35 from 38, and again we expect to be at or around 30 by the end of the financial year. I'll pass back over to Adam now. He's got his breath back and he's going to touch on performance and outlook.
Thanks, Paul. So just touching on performance. So 6 months, this is to the end of November. Both the growth and income portfolios, despite having quite different names within them, actually quite similar returns over the 6 months. In line roughly with the FTSE All Share, is not managed to the FTSE All Share, but it is the benchmark of the investment trust. The FTSE All Share closed-end investments index, which is a bit of a reference point, slightly behind over that period. You can see the 1, 3, and 5 year numbers too. A table of returns, which we show for investors, but also for compliance purposes. You can see versus the benchmark over this time, over the last 6 years. And I'll just go back to performance as well. Just one thing I should have said, that this is the NAV performance of the trust. Share price actually been improved on this although we keep a tight discount control, the shares did re-rate a little bit over this period, and we're actually issuing shares towards the end of the period and into the new year. And just in terms of outlook, now CT Global Managed Portfolio Trust shareholders don't just have myself and Paul working on the trust, but we are part of the CT multi-asset team in EMEA. And as Paul alluded to earlier, we're analysing markets and assets across the globe, and we have a large resources to do that. Over 20 people dedicated to multi-asset, and another additional 14 people that work on manager and trust selection globally. So there's lots of different inputs. Myself and Paul, obviously the faces here, but lots of inputs and resource from Columbia Threadneedle. And just our overall team view, starting with global growth, is that we think global growth is trending quite well, actually, and positively. It'll be at least as strong as last year, probably better, actually. And there's huge amounts of fiscal stimulus which is going on globally. So if we start with US, you've had the one big beautiful bill passed in 2025, but also Japan, Germany already announced substantial fiscal packages. And then if we look at Asian emerging markets, if we see the Chinese economy slowing, we really think the Chinese government will put pedal to the metal and stimulate the economy there too. So in that respect, we see global growth as holding up pretty well. Inflationary pressures somewhat under control now. And if we look at the US administration, pretty keen to run the economy hot, it seems. Large fiscal spend, infrastructure capex. And so although there was lots of volatility last year around trade, I think it's now out in the wash a bit that it's used as somewhat of as a negotiating tool. Tariffs are down substantially from where their rate was in April last year, and economies have continued to grow. So that's our global growth view. But in terms of earnings growth, which is really most pertinent for our investment markets, well, you may, and we all may read gloomy outlooks of what markets may and might do. But actually, as a team, we're pretty sanguine still for earnings growth and what we would say are risk assets, so equity markets. And we're expecting earnings per share growth to be still double digits in most equity regions through 2026. So we still think companies are growing. We've seen so far in earnings season so far this year a strong beat when it comes to earnings, despite some volatility in areas such as software. So absent a macroeconomic shock, we think that we should be still leading to pretty decent returns from equities. And so we're quite happy to keep the portfolios positioned in that sort of pro-risk viewpoint. And what could knock markets, but it could be, companies taking on too much debt, but we think balance sheets are pretty strong. Much of this AI infrastructure spend has been funded from cash or cash flow rather than debt. But we would add, we're starting to see some pretty large debt deals now coming to the market. So there are big debt packages that are coming to try and fund this. And so far they've been heavily oversubscribed, which means there's lots of investor appetite for these deals. But if that starts to wane, well, we'll see how that develops. And then geopolitics, it's everyone's favorite subject. I'm sure we all talk about it, family and friends, and it often gives us reasons to be fearful. And there's lots of headlines out there and pretty fanatical reporting about President Trump's every sort of word. And some of that is warranted, of course, and instability can be pretty unsettling for markets at different points. But we just wanted to make the point that with different changes also come opportunities. And so if we take like European defence shares, now we're not investing in single stocks, but we think it's useful just to pick out that European defence shares pretty dormant for many years. European defence budgets underhit their NATO commitments. Governments made sure that defence contractors' margins were kept in check, due to their procurement policies. But if we look since the President Trump was elected, and somewhat of a reapproachment when it comes to Europe, European defence shares have performed very, very strongly. In the UK, you have companies like BAE Systems, which are up 50%, Babcock up over 200%, and Rheinmetall in Germany up 280%. And our point here is not to make a political point on what we think is the right or wrong outcome, but just that with geopolitics also come opportunity, and so we're just alive to those as and when. I think our overall comment is that there's lots of potentially good news that are priced if you look at sort of market valuation levels, but markets can stay like this for a long period of time. Markets are higher quality perhaps than they've ever been before, and often market new highs or all-time highs in markets leads to more all-time highs in new markets. And so we think really, while momentum is strong, unless we see a macroeconomic shock on the horizon, we're quite comfortable keeping this pro-risk position in public and private equity and selective alternative investment trusts too. And so with that, we'll move on to Q&A. And Peter.
Thank you, chaps. Peter Brown here, part of the investment trust team at Columbia Threadneedle. Thank you for listening in. Thank you for your questions. If you have questions, please put them in the chats and we'll get round to them hopefully by 11 o'clock, which is our cut-off time. If not, we'll answer them post the webinar. And the presentation will be available for download post the webinar as well for your viewing. Chaps, we've got a couple of questions here. We'll start with asset allocation or manager. What is your preference? And I'll fit it in with a question. In your filtering criteria, you didn't mention culture. Is there a reason for this? Do you consider, for example, growth mindset, humility, not being greedy, etc., as positive attributes for managers and boards? So basically, it's an asset allocation stroke manager and what you see in a manager and what you like in a manager.
I could take the filtering criteria one. That is definitely something we look for. Investment culture is very important, and we look at it both as culture for the investment team, but also the broader company, and how does that filter through to that investment team and therefore the process. Confidence is one thing, but humility is something you really look for as well. And some of the best managers we've ever met in our careers really like to focus on where they've made mistakes, and they go back and look at the process, look at the data. Where did something go wrong? How can we improve on that going forward? And we found some, various examples over the years. One of the new investments that we bought for the portfolio since the end of November very much has got that that sort of humility approach, and we'll report on that next time we do a presentation. But that is something that's very important to us. Yeah.
And just in terms of the first question as well, in terms of allocation or manager, I think we want to make sure we control the exposures at a sort of top level to make sure that we're invested in asset classes where we see strong growth. So we could have two equally favorite managers, and you take last year, we could have had them one in Asia and emerging markets and one in UK small cap, and we rate them equally the same. But unless we make that allocation decision correctly, you're going to capture the returns of the UK small cap manager versus the Asia and emerging markets manager, which has performed very strong. So the first decision is really making sure the exposures are correct, but we spend most of our time after that really understanding the manager and what makes them tick and what makes performance tick. Back to Peter.
Not sure. I might have to host the Q&A.
Over to Paul.
I think Peter may have dropped off. There's a question here. What is a global portfolio allocation? Is it largely US? I can take that. There is some US exposure. You saw one of the positions that we added to in the growth portfolio, which is JP Morgan Global Growth and Income. That has about the benchmark weight in the US, which is around about 70%. That is very much a portfolio of the extremely experienced analyst banks' best ideas, essentially. Where we're looking for new ideas in a global space, that it has there's less US exposure. So we're looking for a diversified approach. We're looking for managers that can generate and have been able to generate strong risk-adjusted returns, not just by being in the US. So one of the new investments we've got in our portfolio has a much lower than benchmark weight in the US, but has a decent amount of exposure in UK, Europe, and Asia and emerging markets. So it's very much a mix, I would say. Answered my own question there. The next question is what the look-through discount and gearing figures of the portfolio are.
Yeah, we come back in terms of the look-through discount. I would say that the particularly in alternatives, we see private equity see quite large discounts at play there, then versus say public equities. So and that's an area we've been adding to, but we'll come back on where we see the aggregate numbers.
Hi chaps, sorry I'm back. Oh yeah, I just lost the connection there for a bit. So basically I was trying to push a bit of private equity conversation with you. We know that private equity has underperformed listed markets over the last couple of years, but you have a good exposure to private equity, which is one of the advantages of an investment trust wrapper. You mentioned some of the holdings. Do you now have a brief breakdown of exposure, sort of geographically, sector or enterprise value within the portfolio in the private equity holdings?
We can talk about some of the private equity holdings. If we just go to what we have sold from the portfolios. So just touching on that, Pantheon International sold from the growth portfolio, and Apex Global Alpha Partners was essentially acquired and taken private. And so, but what this may mask a bit is what is our preference. We have a preference more for the sort of direct managers that are invested in their own funds or holding assets essentially on balance sheet. And so we're not necessarily as interested when it comes to the diversified fund of funds. Now you can see optical discounts there, and you definitely capture private equity beta there. But I think when we're holding them as a collection of different private equity managers and versus our own overall opportunity set, we want to get most bang for our buck when it comes to listed private equity. So I think I touched on earlier Oakley Capital, that's around 5% of the growth portfolio, but we also, and that may be sort of, that's at the top end. We've touched on Schiehallion, which is around 3% of the global of the growth portfolio, but we've got much smaller managers. So we've got Literacy Capital, which is just under 2% of the growth portfolio, a collection of almost, not even small, micro private equity businesses in the UK, managed by Richard and Paul Pinder. And so very, very different exposure. And they've had some fantastic exits over the last few months. And still trades at a discount to NAV, and even returned capital to us last year through a different B share scheme where they've had a big exit and they gave us the cash back. Very different managers, different sort of market cap levels, but really it's the direct managers where we can get under the bonnet, I guess, of the portfolio rather than the more diversified exposure that we're focused on. I saw there was a question on another question on private equity, but maybe that's answer that too.
Yeah, that's fine. That's fine. Quick question. The question is, why don't you invest in REITs? I don't know if you do, or if you've got them in the portfolio, but what's your thought on REITs in general?
It's an area that we're looking at definitely much more closely. We do have exposure in the TR Property Investment Trust in both portfolios, which is a portfolio essentially of REITs. So we do have exposure to that space, and we do invest in REITs in one of our open-ended funds that we also manage. It's an area of focus for us, and we're doing a bit of work at the moment. But we're not against adding to REIT exposure. Essentially, there's got to be obviously the right time in the cycle. It's looking more attractive at the moment.
Yeah, I would add to that as well that REITs can be quite sensitive to interest rates, and some of the alternative areas of the market are also quite sensitive to interest rates. So some of the renewable energy infrastructure trusts, now they're going through a bit of their own issues now, and it's just balancing the amount of sort of interest rate sensitivity that we have. But REITs are definitely on our radar to be doing work on. There are fewer of them in the investment company sector than there once was, but it'll be an area of focus for us.
Thank you. Moving on to gearing. Are you geared? What are your thoughts about gearing? And do you know any look-through gearing in the portfolio?
I think this is the one we took. Why is you on power down, Peter?
Oh,
but,
sorry.
we
Ignore
can come
me.
back
Sorry.
on the look-through gearing. In terms of gearing in our own portfolio, gearing is used in the income portfolio currently, and so we have a number of levers that we can pull to sort of add and dial down risk in the portfolios. So one is the composition mix of investment trusts that we use. One would be gearing, and then we can use like cash as a bit of a flight to safety if required. And just taking a step back, our overall view is being pro-risk. So we've been adding to equities, public and private, through the last 6-7 months. We've been adding risk that way. I would say we're geared just under 10% in the income portfolio using our RCF facility, and we'll continue to just reevaluate whether we want to add more gearing to the portfolios as and when required. But I would say over the last 7 or 8 months, we've been adding risk through the composition rather than just an outright use of gearing.
Lovely, thanks. Yeah, if I repeat a question, then please just tell me to move on.
I think that was the only one, so you're right.
Okay. With regards to dividends, obviously very important for shareholders, certainly in the income trust. In view of the move away from the UK in the income portfolio, will there be a reduction in expected income from the investments? Do you still commit to increasing dividends to shareholders, which is obviously a board's decision, but clearly one that you're aligned with?
I would say that it's a balance. Now, so within the income portfolio, I guess the net move that we've made has been towards trusts which have a really good using the investment trust flexibility and structure. So that may be more capital or NAV based dividends. So if we go back to that example that we used earlier on Invesco Asia Dragon, the managers are not targeting yields. We're capturing total return of the manager, but it's the investment trust which gives us the yield from the portfolio, topping up the income. So we've been able to balance it some through that. But I think what we are keen not to do is invest for just yield's sake only, where we think you may get a higher yield, but if you get capital erosion over time, we don't think that's a great outcome for investors either. So we do spend a lot of time balancing both the capital and the income. Now the shares of the income portfolio still yield around about 6%, which is quite a significant premium to the FTSE All Share equivalent. So I said a high level of income there, but we want to focus on total return. And the alternatives that we've been adding to the market aren't not the most highest yielding alternatives that we can add to. There are a balance of both capital and income, where we get a decent level of income, but we're really able to generate total returns from the trusts. I don't know if you've got anything to add, Paul.
Yeah, I would just add that you covered it off with Invesco Asia Dragon, but and there's a question I've seen come in about growth investment trusts introducing enhanced dividends. I think that is definitely a trend that we have been seeing over the last couple of years, and it gives us a good opportunity to invest in those type of trusts that have that opportunity to grow capital as well as dividend, because it doesn't mean that the managers themselves they don't have to chase high yielding stocks. They can just apply their proven process and use the flexibility of investment trust to transfer from capital to income. So you do get that balance. So I think it gives us a better opportunity now that we have that in the market to really position the portfolio for a combination of growth and income.
Question here regarding market risk. With high exposure to technology, private equity and emerging markets, how are you managing risk if market conditions gets worse?
Yeah, I mean, that's a great question. Thank you for asking. So we start with our investment process as a multi-asset team, which is, analyzing markets and different assets, and we want to be intentionally pro-risk at the moment. And so, whilst different markets move in different directions, that gives us some diversification, which is great, which is what we want. But in aggregate, we want to be pro-risk. So our decision to essentially de-risk the portfolio will be made because of all of the inputs and resources that we have from our multi-asset team, which we are a part of. And so the intention isn't necessarily to be defensive right now. It is to be somewhat pro-risk, adding to public and private equity. I wouldn't necessarily say adding to a region like emerging markets is risky if we see the value and the underpinnings of total return. So we touched on earlier what we see is like investor flows. If we're seeing that and we see compelling value opportunities, in our view, the risk is not investing correctly in that area and the opportunity cost of not investing in that area and missing that opportunity. So hope we've covered a lot of bases, but hopefully you get a feel for the large level of inputs which go into the decision making here. Myself and Paul are at the face of the investment trust decision making process, but there's a huge amount of inputs which are going to help us analyze market risk and threats.
Lovely. And I think I've got one final question before we wrap up. If I haven't got to your question, we'll answer them post webinar. Obviously in the news quite a lot about Saba and activists and being very active in the market. What's your view on his actions? And you may be aware he's trying to list an ETF of investment trusts, which obviously could be seen as a poor comparator to one of your offerings. What are your thoughts on Saba and what they're doing to the sector?
If I just go back to our investment company or investment trust selection. So corporate governance is a major part of our investment company selection. That's looking at board behavior, ownership, capital allocation policies, etc. And activism, in its broadest term, has been helping corporate governance improvements for the best part of a decade. Now, when myself and Paul were investing in investment companies 10 years ago, we'd have discussions with boards, and we maybe one of few shareholders doing that. That has improved dramatically. We would find that boards are more forthcoming now when it comes to engagement with shareholders, and so we've seen quite substantial corporate governance improvements. The role of Saba has probably helped accelerate that. Now I will leave others to decide the merits of the intentions, but if we see more proactive corporate governance from activists more broadly, we think that's constructive. We prefer to be it's within our sort of toolkit of things to do when engaging with boards, and we prefer to be sort of more critical friends, I would say, when it comes to boards, and we do speak to lots of chairs, and we'll roll up our sleeves if we need to. But yeah, so it wouldn't be for us to be the heavy activist approach. I would say improvements in corporate governance have been occurring for the best part of 5 to 10 years. There's probably been some acceleration of that. And trusts which, public equity trusts which were trading on 12 to 15% discounts 2 years ago, not buying back shares, have probably improved their capital allocation policies in the last year or so. So we think that's not a bad thing.
Yeah, just having thought about the question regarding dividend, just to clarify what we were trying to say there, given the opportunity set in the market in terms of having that availability to invest in capital growth and income growth, there are no plans for us to reduce the dividend. In fact, we've got reserves that we can use to continue to support and grow the dividend if required. I'm not sure you've got any additional thoughts on that, Adam, or any additional comments?
No, the reserves are there for us to use, which is great. And so that allows us flexibility as managers to not necessarily target investment companies with high dividend yields just to capture the yield. It allows us to be more flexible, gives the CT Global Managed Portfolio Trust more remit, and drive total returns that way.
Thanks, chaps. We'll end it here. Thank you, everybody, for listening. If I could just pass back to you for a final summary, and then we'll hand back to the moderator. Thank you.
Yep. Take this bit. Just to summarise, it has been a very busy period for the portfolio trust. We've sharpened the number of holdings so far. We intend to do more over the coming months. The allocations have shifted towards where us as a multi-asset portfolio team see best risk-reward opportunities, and we still have a pro-risk, pro-equity position, and therefore we want to be exposed to public and private equities. If we see a shock on the horizon, we will change our minds, and we have enough humility to do that. But at the moment, we see strong corporate growth, corporate earnings growth, and still try to capture opportunities through that.
That's great. Thank you for updating investors today. Can I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of CT Global Managed Portfolio Trust PLC, we'd like to thank you for attending today's presentation, and good morning to you all.